Financials are plummeting, down nearly 2% this week, with a bearish trend emerging, driven by rising regulatory pressures. This is what every serious investor needs to know about financials right now. Stay with me. Welcome back, or welcome if you are new to Financial Market Oracle. This week, the overall market context is one of normal conditions, with the VIX at 18.7, indicating a relatively stable environment. In this context, the financial sector is standing out, as it has underperformed the S&P 500 this week. The financial sector ETF, XLF, has declined by 1.93%, which is a notable move. This underperformance is particularly interesting, given the importance of the financial sector in the broader market. As a key component of the S&P 500, the financial sector deserves attention right now, especially as investors assess the impact of interest rates and economic trends on bank profitability and financial institutions' performance. With the current market regime, investors are closely watching the sector for signs of strength or weakness, which could have broader implications for the market. This week, we will delve into the financial sector, exploring the trends, risks, and opportunities that are shaping its performance. Please keep in mind that this is educational content and not financial advice. Let us start with the technical picture and what the charts are telling us. For the financial sector, as represented by the XLF ETF, we saw a weekly decline of 1.93%, but still a monthly gain of 4.22%, which suggests some level of momentum is still present. However, with an RSI reading of 62, we are starting to see a bearish signal emerge, indicating that the sector may be due for a period of consolidation. This RSI reading implies that the sector is approaching overbought territory, which could lead to a pullback in the near term. The trend direction still appears to be upward, but conviction is starting to wane, as evidenced by the recent decline. Key support levels likely exist around the recent lows, while resistance levels are likely to be found at the recent highs. The current move does not appear to be a sustainable breakout, but rather an extended overreach, which could be due for a correction. This week, we will be watching for a potential technical setup that could confirm a breakout or a reversal, as the sector navigates this period of consolidation. Now let us look at the fundamental catalysts driving this sector. The financial sector is poised to respond to several key economic events this week, including the GDP advance estimate for Q1 2026, PCE inflation data, non-farm payrolls, and the highly anticipated FOMC rate decision. These macro data points will provide critical insights into the health of the economy and the potential trajectory of interest rates, which in turn will impact the financial sector. The key stocks, such as JPM, BCGS, WFC, and Berkshire Hathaway New, are signaling a mixed bag, with some banks showing resilience in their recent earnings reports, while others are facing challenges. Please remember, this is educational content and not financial advice. The longer-term fundamental thesis for being positioned in this space remains intact, driven by the sector's ability to generate profits in a rising rate environment, as well as the growth potential of fintech and asset management divisions. However, the current macro environment also presents some headwinds, including the potential for increased regulatory scrutiny and the ongoing impact of inflation on consumer spending. With the VIX at 18.7, market conditions are relatively normal, and the financial sector is likely to remain sensitive to these macro developments. Next, let us talk about the specific risks you need to manage this week. The financial sector is facing significant risks this week, primarily driven by regulatory uncertainty, interest rate volatility, and geopolitical tensions, which could lead to a decline in investor confidence, and as a result, impact sector performance. Given the current volatility environment, with the VIX at 18.7, investors should be cautious with position sizing, focusing on quality names with strong fundamentals. Unexpected headwinds, such as a surprise rate hike or a major bank failure, could further exacerbate downside risks. To manage this exposure, a disciplined framework is essential, incorporating stop-loss orders, diversification, and a thorough review of portfolio holdings. By adopting a proactive approach to risk management, investors can mitigate potential losses, and as we consider these factors, it is essential to remember that this is educational content and not financial advice. And now for the strategic outlook, where does financials stand heading into next week? For the financial sector, we maintain a cautious stance this week, given rising interest rates and potential volatility. A key theme to track is the impact of monetary policy on bank earnings. This is educational content and not financial advice. We encourage you to like, subscribe to Financial Market Oracle, and comment your financials watch list below. Until next week, stay informed, stay disciplined, and stay profitable. Cheers! This video is for educational and entertainment purposes only and does not constitute financial advice. Always do your own research before making any investment decisions. Past performance is not indicative of future results.